Hello. Very good morning, everyone. I hope you all are doing good and your preparation is going in full swing. So, we are back again with the last part of FSR report. We will try to complete the report today, right? So, in the last class, we were discussing several impact of the or findings of the stress test, macro stress test, sensitivity analysis and all these things on two different entities. So far we have discussed this thing on the SCBs, on the urban cooperative banks and all, right? And the findings have been quite good. So that is the thing. Now today we will resume from here, which is non-banking financial companies. So for NBFCs, what all are the indicators or resilience indicators or soundness indicators, right, for NBFCs? So first thing which we have in the series is credit growth. So if you have been following the classes, you all know that we have discussed credit growth, capital adequacy and all these things for all these entities. So credit growth, if you see, NBFCs have maintained robust credit growth. NBFCs have maintained robust credit growth. So remember this point here, despite some moderation in the second half of the year. So despite some moderation in the second half, still if you see the overall scenario, they have been able to maintain robust growth. This is the take. Then category wise, if you see personal loan growth, it fell down, whereas growth in loans to industry and services, they have accelerated. Can anyone tell me the reason for this thing? Why personal loan growth fell down for NBFCs but it has increased for industry and services? If you could think of the previous classes, if you are able to recall them, we have discussed this thing that RBI is, strictly monitoring the retail loan segment and particularly of the NBFCs, right? We have discussed this thing. That is the reason. So there are stricter regulations and guidelines being imposed on the NBFCs for personal loan or retail loan, right? Consumer loans. That's why you see the retail loan share, it has been falling down, but then the loan or credit growth in terms of credit extended to the industry and services sector has accelerated for NBFCs. So try to attach to the reasons. That's how you tend to remember these trends for a far longer period of time. Next, if you see major categories in the personal loan segment. So what are the categories and the trend among them? If you see vehicle or automobile related loans, 34.6% share they constitute in the retail loan segment. Then advances to individual against gold loans, right? Then microfinance or loans or credit given to self-help groups, and then they recorded lower growth than overall growth of the personal loan segment. So here comes a question. So if they ask you this question that okay, you know that personal loan growth has been on a declining trend, but what are the categories particularly which have witnessed this declining trend in the personal loan segment? So the categories are like this, right? So the most largest category, if you see vehicle and auto loans, which constitute 34.6% share of the retail loans extended by the NBFCs, they are there. Then loans advanced against the gold or gold loans, then microfinance, then self-help groups, they have recorded the lowest growth in the credit segment. So remember this distribution and bifurcation. Then growth in industrial advances was largely contributed by government NBFCs, particularly this thing also there. Now there's this different trend. If you see, PSBs are performing very well. So I think they can ask you questions on this, because a longer trend is now being wiped out. So PSBs particularly, there was a time when they were seen with doubt that they are not performing their banking functions properly and as efficiently as compared to the private sector banks. So this is somewhat, the chain is breaking down now, right? So they are coming out of these shackles. So this is why this sector becomes important, PSB. So you remember that this overall growth of NBFCs in the industrial credit segment is particularly contributed by government NBFCs. Is this clear? right, by government NBFCs. Then credit growth in respect of largest category of NBFC by activity if we see. So by activity, you have different categories of NBFCs, isn't it? You have housing finance companies, you have infrastructure related NBFCs. So depends on their core functions, right? Among the core functions, broadly two categories you have here, the largest of the two, the first largest and the second largest. So first is your investment and credit companies. Investment and credit companies, the credit growth in this section of the NBFC has been accelerating in the post-pandemic period. So remember, investment and credit NBFCs are witnessing growth in the credit segment. Then infrastructure finance companies, so NBFC, IFCs, infrastructure finance companies are for them the growth has moderated, which is the second largest category. They have moderated after witnessing double-digit growth for 4 successive quarters. So a question can be framed from here. What is the question? That among the two largest segments in the NBFCs or types of NBFCs, which one is there which is continuously witnessing acceleration in the credit growth, and which one is there which say, for example, this one has seen double-digit growth, but now the growth is moderating. So the first one, as you all know, is the NBFC is related to investment and credit companies, and the second one is the infrastructure NBFC. So remember this thing about the NBFC. Then if we move on to the GNPA ratio for NBFCs, GNPA ratio, including those under resolution process, it has continued to decline, and that is good. So for NBFCs as well, the gross NPA is declining. That is a good sign, and that is a result of sustained efforts of the regulatory bodies, right, for a long period of time, and their stricter guidelines. So trajectory in the post-pandemic period, now it has reached to 4% as of March 2024. So as of March 2024, it is 4% GNPA, gross NPA for NBFCs. In retail segment, if you see vehicle auto loans, they had the highest GNPA ratio. That's why you see these categories, they are being targeted, isn't it? Because they have the highest NPA ratio in the retail segment. So a question can be framed here as well. In the retail segment, the highest GNPA to the loans extended by the NBFCs, in the loans extended by the NBFCs, is in vehicle or automobile sector, which is 5%, right? The overall is 4%, it is above that, it is 5%. While other categories in the retail loans, they stand below 3%. So this is something which I can tell you that is in the eyes of the examiners, right? So a probable question can be here, which segment is there which is causing an increase in the gross NPA for NBFCs? It is vehicle and auto loans. Remember this thing. Then private NBFCs industrial advances, not the government ones. If you see the private NBFCs industrial advances, which account almost 1/5 of the overall GNPA stock, they also saw further moderation. But if we see the aggregate net NPA, so we have talked about the GNPA. Now if we see the NNPA ratio of NBFCs, it has improved further due to higher PCR and fall in the GNPA. So if you see the net NPA, now what is provisioning coverage ratio? We have already discussed, right? So due to higher provisioning coverage ratio, higher provisions being made by NBFCs against their total assets, the net NPA situation is improving, right? So the aggregate NPA is higher, it has improved due to higher PCR and fall in GNPA. So if you see this combination, overall the GNPA is falling and the PCR is rising. So net NPA situation is improving for NBFCs, right? Gross NPA mein some are performing good, some are not performing well. There's a segment which is vehicle and auto segment which is contributing to the rise in the gross NPA. All other segments, they are not contributing to a substantial extent. Remember this thing. Next, capital position, if we see for NBFCs. So for NBFCs, the CRAR stands well above the minimum regulatory requirement. So 26.6 as of March 2024, and the minimum regulatory requirement is 15%, right? So this is well above the minimum regulatory requirement. Then if you see the liquidity stock measure for NBFCs, liquidity stock measure, so the ratio of short-term liability to total assets remains below 25%, and then ratio of long-term assets constitutes about 2/3 of the assets, and the commercial papers, they had less than 2% asset in the total assets. Now what does this indicate? This indicate the preference, liquidity preference of the NBFCs. So it clearly tells you that NBFCs are not relying on short-term assets or short-term fundraising or debt raising instruments like commercial papers, right? So commercial papers are short-term unsecured promissory notes, as you all know, issued by your corporations and financial institutions, right? So they are relying less on the short-term funds. Longer-term liquidity with stability is the preference what you get from here. I hope this is clear, right? So remember, liquidity stock measure mein ratio of short-term liability to total assets is below 25%, and ratio of long-term assets and liability is about 2/3 of the assets. But the commercial papers, okay, thank you so much for this, but let's complete the classes first and thank me if they become useful for you in the examination, right? In that case, I would accept it wholeheartedly if it becomes of any use for you in any of these stage of the examination. So this is the thing. Now next thing which we have is, sorry, share capital. So this is again liquidity situation. Share capital, reserves and surplus of NBFCs, they have declined. Now this is not a good situation. So remember this thing. The share capital, reserves and surplus of NBFCs have declined in 23-24 and constituted 28.3% of their total liabilities. Remember this figure, 28.3% of their total liabilities as of March 2024. Now first let's see the borrowing figure as well, then I'll give you a contrasting analysis. That's how you will be able to retain these information, right? So first thing is this. Next, their borrowing from banks rose gradually. Borrowing from banks, so interbank operations or exposures have been increasing, right? Borrowing from banks, it rose gradually over the years, while mobilization of resources through debentures declined, and mobilization through commercial papers, as we have seen, has remained almost unchanged. As of March 2024, about 4/5 of the funds sourced from the banks were secured in nature. Now, two analysis we need to focus on from these two paragraphs, right? First point, share capital, reserve, surpluses of NBFCs have been declining. That can pose liquidity risk to the NBFCs. This is something which you get from this point, right? Next thing, but the good part is, if you see, the NBFCs are now focusing on more secured fundraising instruments and channels than the unsecured one and the short-term one. This is the catch from here. Now this is the trend, so you will be able to eliminate the options if they ask you this kind of question, right? So remember, CPs, commercial papers, they are relying less, they are unsecured, they are short-term, but they are relying on more of the secured options which are bank credit. So their share, their borrowing from the banks, it has rose gradually. This is what you get from these 2 points. Right? So this was regarding the resilience and profitability. Now if we see the stress test, the concept of a stress test we have discussed in previous 2 classes. So same stress test is now being applied to NBFCs as well. Let's see what are the findings. Same methodology is there, baseline scenario, medium severity, severe stress, medium stress, all these things. Yes, what is important is, remember, how many NBFCs have been taken for the sample. So if you remember, in scheduled commercial banks they were 46. How many UCBs were taken? Can you tell me? How many UCBs were taken? Yesterday we have discussed for the stress test. How many urban cooperative banks were taken in the sample? So you have to remember this figure. And if we talk about the sample size of the NBFCs, so remember this 16,335 NBFCs have been taken in the or incorporated in the sample for taking these stress tests. Testing methodology is again the same, baseline and then two stress scenarios, the medium stress and the severe stress. Now the important part is the test result, right? Test result. First, under baseline scenario, if you see 1 year ahead scenario, so 1 year ahead GNPA ratio for the system is estimated to be 3.5% and system level CRAR at 21.7% with CRARs of 8 NBFCs falling below the minimum regulatory requirement of 15%. So if there is any baseline scenario related risk, if there is any risk, so under baseline scenario, the GNPA in 1 year would be 3.5. So not a big issue, right? Then system level CRAR, talking about all the NBFCs in the system, right? System level CRAR will be still at 21.7%, right? So then with the CRARs, but individually if you see 8 NBFCs CRAR is expected to fall below the minimum regulatory requirement of 15%. So overall system level CRAR will be at 21.7, but 8 NBFCs might get affected. This is the baseline scenario. Then if you see the medium and high risk scenario, so under medium and high risk scenarios, income loss and additional provision requirements, these two factors, they are expected to reduce the CRAR of this sector, NBFC, right, by around 70 basis points and 90 basis points respectively. So remember, under medium and high risk scenario, due to two factors, income loss and additional provision. So due to income loss, it might reduce the CRAR by say in the medium scenario by 70 basis points and 90 basis points respectively. These two are the factors, income loss and additional provision. So you have to maintain additional provision that can also be a cause of fall in the CRAR. I hope this is clear, right? Then moving further, liquidity risk if we talk about. So the resilience of the NBFC sector to liquidity shocks, it has been assessed on the basis of how much increase is there in your net cash outflows and decrease in cash inflows. Say your outflows have increased, simultaneously your inflows have been decreased. In that case, what impact will be there on the liquidity situation of the NBFCs? So particularly talking about the liquidity. So it was observed that liquidity mismatch over 1 year will mostly remain 20% or below. Due to these mismatches in the cash outflow, rise in cash outflow and fall in cash inflow, liquidity mismatch for the NBFCs would be around 20% or below, not more than that, 20% or below. Only one small NBFC may experience over 50% liquidity mismatch under high risk scenario. If it goes under high risk scenario, there will be only one NBFC, and that too small NBFC, which has in the entire sector, which has only 0.1% share in the assets of the sector, will say is expected to experience over 50% liquidity mismatch, not more than that, and that one is also a smaller one. So liquidity risk is not so much of a concern. I hope this is clear, right? So this was about the NBFCs. Now we are moving to a new sector, which is insurance sector. This is again important. What are the stress tests and their findings related to insurance sector? Let's discuss them quickly. So first, stability metric or solvency ratio. 170 UCBs, okay. Stability metric. So first of all, in the insurance sector, the report has mentioned what has been the solvency ratio. Solvency ratio, as you all know, solvency ratio of an insurance company, it assesses the ability to meet your, say, day to day. What is solvency? To meet your liquidity requirements, operational requirements, right? Payment obligations. So solvency ratio tries to assess the ability of the insurer to meet its obligations towards policy holders, right? So it reflects how many assets you have in comparison to your liabilities. Simple. So on the basis of solvency ratio, the report says minimum solvency ratio set by IRDAI for insurance companies is 150%. So remember this thing, remember this figure, right? Remember these figures. That means out of the required minimum solvency ratio, right, or required minimum reserve, what is required minimum ratio? So you have to keep, as per IRDAI guidelines, you have to keep certain proportion of assets. How many assets do you have to meet your say liabilities, right? In that case, out of that required one, this percentage should be the minimum solvency ratio requirement. So it should be 150%. It should be 150% of that. I hope this is clear. Remember this figure, it is important, right? Next, now why solvency is kept so higher? So because higher the solvency, it reflects more stability. You will be stable in your payment obligations. Simple logic, right? So higher the solvency, better will be the ability of the insurer to meet its liabilities, and lower the solvency, higher chances of instability in that case. So remember 150, okay? Then current findings regarding insurance sector. At an aggregate level, if we see the solvency ratio for life insurance companies, it has remained above the prescribed threshold. So if you see, what is this prescribed threshold in terms of, say, crores or absolute numbers, it differs. It differs in your core functioning or category which you belong to of the insurance market, right? So say general insurance companies are there, then you have life insurance companies. So for life insurance companies, this minimum threshold is 50 crores, not for general one. So it depends. You need not remember every threshold, just remember life insurance companies minimum threshold to be maintained or requirement of the assets is 50 crores. Clear? Okay. So generally they have kept this thing above the required minimum threshold. This is the thing the report is highlighting. So this is not an issue. Okay, that is good. For both public and private sectors, the solvency ratio for public sector non-life insurance stood below the baseline prescription. So if you see solvency ratio for public sector non-life insurers, it has been below the threshold level. Okay, so this is a concern. So the concern arises from the public sector non-life insurers. But life insurance companies, they have generally kept the minimum solvency requirement above the threshold. This is the catch. So life insurance companies are performing good. Non-life insurance companies are a cause of concern. Okay, and that to the public sector ones, not the private sector ones. Now here's a table in front of you. You can remember these figures from here and it can be important for examination. This is table. So if you see solvency ratio of life insurance sector, okay, public sector you have, then private sector and industry. So it is given for March, June, September and December 23. You can remember at least this much, okay, and this much. both the figures. So March 2023, it is for public sector 187. Now this is in percentage, right? For life insurance 187, private 228 and industry के लिए 197. Then if you see this one, so public sector 193, private sector 215 and the industry 198. Just you can remember these two, March and December 23 data, okay, from this table. So this was about the insurance companies. Now you have the mutual funds. Mutual funds may as well. So based on SEBI's directives, there have been a stress testing which is done, because it also constitutes an important part in the entire financial system. We cannot ignore that, right? So let's talk about the mutual funds and their health, right? So let's talk about the health of those who create your wealth, right? So this is the tagline I just flashed in the mind. So what is the health of those who create your wealth? So stress testing of mutual funds, SEBI's directive. First of all, what is the SEBI's directive? The Securities and Exchange Board of India has mandated the asset management companies. I hope you all are clear with these concepts at least, right? Asset management companies, so they manage your assets basically, and somewhat kind of similar to the mutual funds, but not identical. Remember, to carry out a stress testing of all open-ended debt schemes. So according to SEBI's directives, a stress test was done on the open-ended mutual fund schemes which are there in the market, okay, except overnight schemes every month to evaluate the impact of various risk parameters on these schemes. Now what are open-ended mutual fund schemes? Open-ended debt schemes or mutual fund schemes are these schemes which do not have a, say, fixed interest rate or fixed amount associated with it. You, on the time period, if you ask me, time period is also flexible. So you can, the units of these or under these schemes, they can be bought and they can be redeemed at any point of time, but within the life of the scheme, right? During the life of the scheme. This is the one or two important features about open-ended debt scheme. I hope you will remember that. So on these things, so if they ask you that for mutual funds, what are those schemes onto which these stress tests have been done? So these are open-ended schemes or open-ended mutual fund schemes. Now talking about the results and all. So first thing, the AMFI, the Association of Mutual Funds in India, and each asset management company, they have specify the thresholds of impact of risk parameters, right? Breach of either AMFI's or AMC's threshold requires reporting and remedial action. Remember this thing. Before discussing the results, the Association of Mutual Funds in India and then your each asset management company, they specify certain parameters, okay, of the impact for risk parameters, whatever parameters associated with the risk are. If you breach these parameters, then it requires reporting. That means if you have been breaching these parameters, you are at a risk. So it should be reported and remedial action should be taken effectively. Then in April 2024, 28, remember this figure, 28 open-ended debt schemes with total assets under management of 1.76 lakh crores, they reported risk above the prescribed thresholds. It means it is riskier, right? So remember, 28 open-ended such schemes with their asset under management, you know what is AUM, right? Asset under management is the total market value of all the instruments you have held, right? Or say whatever outstanding shares are there of the, or stocks are there which you have invested into or you hold on the behalf of the investors. So this is AUM. With AUM of 1.76 lakh crores, 28 schemes, AUM 1.76 lakh crores, their risk is way above the prescribed thresholds of Association of Mutual Fund of India or AMCs. So this is a question of risk management. Then furthermore, as a part of liquidity risk management for these open-ended schemes, two things or two types of liquidity ratios are calculated. Okay, so they assess the proper risk management on these two parameters. First, redemption at risk, and then conditional redemption at risk. So redemption at risk, we talk about redemption at risk indicates how much risk is associated or how much riskier it will be if, say, a large number of the investors, they decide to redeem their holdings, right, simultaneously. This is redemption risk. Then conditional redemption risk. When we try to assess the impact of redemption risk specifically to a given market condition, like when market is highly volatile or the market is very lesser volatile. So when we try to attach the impact of redemption risk with specific market based conditions, we get conditional redemption at risk. So these are certain parameters they use to assess the risk management in the mutual fund schemes. I hope this is clear, everyone, right? So now they are computed, both of these things, liquidity risk associated with redemption at risk and liquidity risk associated with conditional redemption at risk. It is computed for top 10 MFs, right? For 13 categories of these, they were well above the threshold limits. It means they were riskier. Now you will remember this thing, right? Everyone, are you getting all these concepts or no? Right, so they have remained above the minimum or the threshold prescribed by the asset management companies or Association of Mutual Funds of India, right? AMFIs. Remember this thing. So this was about mutual fund and their soundness and resilience. What you get is they are riskier, right? But then where there is a risk, there is a way. So as they say, where there is a will, there is a way. But will is, along with will, you also require risk in the life to go ahead, right? So where there is a risk, there is a way, but still they are riskier. Okay. Then stress testing analysis at clearing corporations. So again, clearing corporations, yes, they are in line with the, no, they give it individually as well, but of course they have to follow the norm prescribed by the SEBI. Okay. Now clearing corporations, again, very integral part of the entire financial system, cannot be ignored. So let's test the stress condition of clearing corporations. So stress testing is carried out at clearing corporations to determine the segment wise minimum required corpus of the core settlement guarantee fund. Now what is this core segment guarantee fund? Core segment guarantee fund is the corpus maintained by clearing corporations to meet with the requirements of settlements done on the stock exchanges, right? Clear? Okay. So this is the fund which the corpus of the fund which they maintain. So this stress test is done to assess how much should be the minimum required corpus under this thing. Okay. How much should be the minimum required corpus. Okay. Now this thing, the minimum required corpus, MRC. So wherever MRC comes now, it would mean minimum required corpus. MRC is determined for each segment, be it equity segment, cash, equity, derivatives, currency derivatives, right, commodity derivatives, debt, tri-party, repo segment, whatever segment, for each segment, right, it is done every month. Remember, it is done every month, and MF also every month, right? Then what are the results? What are the results? So based on the stress testing analysis for the period of October 23 to April 2024, it is observed that though the monthly calculated amounts of the minimum corpus MRC at the clearing corporations, it varied, the actual MRC requirement for equity cash and equity derivative segments, it remained the same in line with the SEBI stipulation. So two segments are there, you just remember this thing, equity cash segment and equity derivative segment for whom the MRC remained in line with what the SEBI requires or stipulates. With what the SEBI requires or stipulates. I hope this is clear, right? Then the MRC requirement in the currency derivative segment, it has increased. So remember 3 things here. 2 segments are there. So 2 segments are there which are in line with the stipulated requirement of MRC, and one is there for which the MRC requirement has increased, right? And that segment is your currency derivative. That segment is your currency derivative. So remember these 3 segments here, they can be important from the point of view of questions, right? Now the risk and the specific risk assessment, sectoral wise risk assessment is done. Now there are other things which the report highlights. So regarding interconnectedness, try to understand this thing that financial entities we have discussed, the SCBs, UCBs, NBFCs, clearing corporations, mutual funds, insurance sector, all these entities, but they do not operate in isolation. The thing is that they are interconnected. So since they are interconnected, that helps them raise funds, interbank operations or interbank exposures, but it helps like globalization, right? Simply try to understand like globalization, we all economies are interlinked to each other, highly interlinked. There is no one economy which is not linked to the other in any way, right? But then it has its benefits and it has its losses as well. So pros and cons are there. Benefits, you get to exchange the goods and services which you do not have, and a lot of benefits. Here, benefits, you get to raise funds from the others which are secured and more trustworthy as compared to the short-term instruments like CPs. But then the risk is also transferred. So for example, if something happens like a financial crisis of 2008-9 in the US, that also gets translated to the other countries and economies, right? So this is what happens. So interconnectedness also translates into more risk or higher chances of systemic risk. If one institute fails on a certain parameter due to any risk scenario, the other one also gets affected, or it might translate into a wildfire and can expand and then result into a systemic risk. This is the core concept here of the interconnectedness, right? So interconnectedness among financial institutions, it involves funding gaps arising from liquidity mismatches and maturity transmission payment process risk transfer. So basically, you try to manage the liquidity mismatches from borrowing with the other institution, but then you also transfer risk to the others. Say NBFC is borrowing from the banks, transfer the risks to the bank, right? So financial system interconnectedness, it can be visualized like a network. So there is a graph coming in the PDF. You will look at the graph. So it is like there are locus points, then there are some institutions at periphery, they are highly related, they are far not so closely related. So there can be a locus like this, right? They may be interconnected. These links could be in the form of loans, investments given to each other, right? So while these links, they enable gains in efficiency and diversification, they can also be conduits of risk transmission and risk amplification. They can be the reason of risk transmission and risk amplification. So remember this point. In period of any crisis, one failure can translate into the entire systemic failure, right? Then financial system network. So let's try and study about this network. So now we are going to discuss what the report tells you about this entire network, okay, the interconnectedness. So first thing, growth and drivers of bilateral exposures. Bilateral exposures, expansion of exposures, total bilateral exposures among the entities in the Indian financial system continued to grow during second half. Now what are expansion of exposure? Exposure means their interaction with each other. Their lending, funding, borrowing activities, investing activities with each other. It has expanded. That means more interconnectedness has been there. This is the thing. Bilateral would mean among the two institutions, but if you see at the larger level, it has increased. Then primary drivers. What are the primary factors for this expansion of the exposures or interconnectedness? The expansion was driven by increasing exposures of asset management company mutual funds. So AMC-MFs, their interaction, remember this figure, the entire systemic interconnectedness has increased, exposures have increased. Now the primary driver of it is more exposures of these asset management companies and mutual funds with that of the scheduled commercial banks and all India financial institutions. Okay, so their bilateral exposures with them and their bilateral exposures with them. Are you getting my point? Yes or no? So exposure of your AMCs or MFs with the scheduled commercial banks, and then exposures of your all India financial institutions with scheduled commercial banks. Both type of bilateral exposures have expanded, have increased. This is the thing, and this is the primary reason, of overall increase in exposures among the institutions. Now before moving ahead, I would want I want you to answer what all are the all India financial institutions, because it is also going to come later. So just give me quickly the names of all India financial institutions which are there in India. AIFIs, list of the AIFIs. Tell me quickly. Anyone? List of the AIFIs you have to tell me. Okay, NHB, NABARD, then SIDB, then these are only two. So NHB, NABARD, Exim Bank, right, Export Import Bank, then SIDB, then NABFID. Okay, so recent addition is NABFID, right? Any other institution left? Tell me the entire list. Okay. Okay, so this is the thing. Then if you see the growth rate, year on year growth of bilateral exposures, it has fluctuated. So bilateral exposures are increasing, but their growth has been in a range. It is fluctuating, but the range is 15 to 18%. Remember the range. Range is 15 to 18%. Then if we try to assess the funding mix, so now we are not discussing about any particular entity, we are discussing about the network of these entities, which we call as a financial market or financial system, right? Now, long-term funding. So if you see the long-term funding, long-term loans and advances, equity and long-term debt instruments, they were major channels for bilateral exposures. So long-term funding is being provided priority, remember, because long-term funding is more stable as compared to the short-term ones. Then short-term funding, if you see, so commercial papers and certificate of deposits, these types of money market instruments which you have, they have played significant roles alongside interbank loans and deposits. So interbank loans, as they take from each other, are there. So long-term funding is also significant, but then short-term funding is also significant. And in short-term funding, these two instruments primarily, two money market instruments, your commercial papers and certificate of deposits, they have played an important role. Remember this thing, right? Next, if we see the segment-wise analysis of funding, so long-term loans, if you see, primarily they were advanced by scheduled commercial banks to NBFCs. Long-term loans, remember these segment-wise trends, they are important, right? So long-term loans primarily who gave to whom? Scheduled commercial banks gave to NBFCs. Then equity investments, so asset management companies or mutual funds, they were major investors in equities issued by private banks and NBFCs. So in the equities issued, so this is how they are interconnected, isn't it? Equities issued by private banks and the NBFCs, the largest or major investors were AMCs and MFs. Then if you see the long-term debt market, not the loans, the debt market, insurance companies, they held the majority of the instruments issued by them. Now this is very, very important. I am telling you. So I have star marked this thing. Remember this segment-wise analysis. If they ask you who has advanced the long-term loans, highest long-term loans, it is a scheduled commercial bank and they have been advanced to NBFCs. If they ask you who have invested more or most in the equity instruments issued by private banks and NBFCs, so AMCs and MFs. Then if they ask you long-term debt market, so debt instruments, long-term debt instruments were purchased, or in these debt instruments the investments was done by insurance companies, debt instruments of private banks, NBFCs and housing finance companies, right? So this was about long term one. Then if we see the short term funding, so commercial paper market and certificate of deposit market, these are the prominent instruments in the short term funding. If you see the commercial paper market, AIFIs, NBFCs and HFCs, housing finance companies, they were largest recipients of funds via CPs or commercial papers, right? With asset management companies or MFs being the largest investor. So who have invested in the commercial papers? AMCs or MFs. Via commercial papers, who have raised the largest funds? AIFIs, HFCs and NBFCs, right? AIFIs, HFCs and NBFCs. Okay. Then if you see the certificate of deposit market, so PSBs, private banks and AIFIs, they were major recipients, with AMC being the largest fund provider. So if you see, the investor is the AMC and the MFs. In certificate of deposits, public sector banks, private banks and AIFIs, they were the major recipients. So public sector banks have also received funds via certificate of deposits. Remember this thing, public sector banks, private banks and AIFIs in the certificate of deposit market, and these two. Okay. Now if you see the inter-sectoral exposures, so overall who stands to be largest fund provider? Fund provider is AMCFC, which you have noted from the above points, right? And PSBs. Largest fund receivers are NBFCs and private sector banks, followed by HFCs. This is important. This is very, very important. So largest fund providers have been your asset management companies, mutual funds, insurance companies as well, and PSBs. So remember these four: asset management companies, mutual funds, insurance companies and PSBs. And largest fund receivers were NBFCs, private banks and HFCs. So first, second and third, first, second and third. Okay. Just remember this thing. Next, if we see the bank group positions, so bank groups, among the bank groups, net receivable position and net payable positions, these two positions are again indicators of their strength. Now what is net receivable position? Net receivable, if you are at a net receivable position, it tells us that people owe to you, right? You have to receive that fund from all those who owe to you. So they will give it to you. If you are at net payable position, that shows you owe to someone. So you have to give it. So it is better to be at receivable position, right? So that would come back to you. So net receivable positions, those banks which are at net receivable position, they are at a good strength. Again, this is very, very important. So they can ask you which bank is there. So public sector banks, again different trend. So public sector banks are at net receivable position, and urban cooperative banks are also at net receivable positions. Then net payable positions may you have private banks, foreign banks, and small finance banks. So remember, public sector banks and urban cooperative banks, they are at net receivable positions, right? And net payable position is of private banks, foreign banks, small finance banks. Now, if you see the interbank market, so interbank exposures were 3.3% of total assets. That means total assets or funds raised by all these institutions via interbank market, interbank funds, they constitute 3.3% of the total one. So interbank exposures have been at 3.3%. Remember this figure, 3.3%. Among this, PSBs continue to dominate. PSBs continue to dominate in this thing. Sorry. Okay. So PSBs, they continue to dominate. If you see the interbank market, okay, followed by private banks and foreign banks, followed by private banks and foreign banks. Then share of PSBs and FBs decreased, whereas share of PVBs increased. Not important, just remember PSBs dominate the interbank market, then private and foreign. Unlike in the overall financial network, in which long-term exposures, they formed a major part, short-term funding plays a crucial role in interbank market. So far in the above analysis, we have seen this thing. Overall instruments, the long-term instruments were preferred, right? But if you see the interbank transaction, so short-term are more. Short-term interbank transactions are dominating. This is it. Then at the end of March 2024, 67% of the fund-based interbank market was short-term. So in the interbank market, short-term funds dominate. In the interbank market, short-term funds, they dominate, right? Remember this thing. So interbank market का network, if we try to understand interbank market network, the distribution of number of links between entities in the interbank market is highly skewed. That means most banks have few links and few banks have many links. That means, say most banks are there which have most banks are there at the periphery, for example, they have a few links with this, with this, with this, with this, like this. But there are few major banks like this, A, B, C. They have many links, maybe with all of them. So this is this kind of a structure. If you see the cluster graph, this kind of structure will be formed. This has resulted into what we call as a core periphery network structure. Remember this name, they can ask you. So interbank interconnectedness or structure is the core periphery. Core is what it at the center, and this is the periphery. So these are at the core, these nodes are at the core, and this is the periphery. So this is the diagram. This is the diagram. You don't need to learn or remember anything from this diagram. You just need to see this, okay? Whatever important facts are there, we will discuss. So if you see this diagram, these small entities, they are at the periphery, but then you see the level of interconnectedness. These are at the core, some of them, right? They have connections with all of them. So this is the structure. This is what we call as core periphery interconnectedness or core periphery structure. Now there are certain features. So in this, 3 banks were in the innermost core. So if you see at the core, there are 3 banks, innermost core. See, 1, 2, 3 might be there, right? So innermost, if you see, 3 are there, or this will be the innermost. So 1, 2, 3. Okay, just remember these points. 3 banks are in the innermost core. Okay, 6 banks in the mid core circle. Remember this figure. This is very, very, very important. Okay, so how many banks? How many banks in the innermost core? 3, right? 3. Then 6 banks in the mid core circle. Mid core circle mein 6 banks, right? Now 3 banks in the innermost core, they include PSB, 1 PSB and 2 private banks. The banks in the mid core were also PSBs and private banks. Most of the old private banks along with foreign banks, SUCBs and SFBs, formed the periphery. This is very, very important. Try to learn this figure right now only, okay? Don't leave it for further. You don't have much time. So how many banks are there in the innermost core? 3 banks are there, in which there is 1 public sector bank and 2 private banks. So public sector banks are at the core, right? One of them at least is at the core. Then if you see mid core, there are 6 banks, among which there are PSBs and private banks again. Then if you see the periphery, so periphery is being dominated by, so you don't have PSBs in the periphery. So try to remember, you don't have PSBs in the periphery, right? Periphery primarily has private banks, foreign banks, scheduled urban cooperative banks and small finance banks, right? Now, the degree of interconnectedness among them, it is measured by connectivity ratio, which has decreased marginally. So there is this indicator which they use, which is known as connectivity ratio, by which they try to assess the degree of interconnectedness among all these core, mid-core, periphery wale banks. But it shows that it has declined. So interconnectedness has declined and the cluster coefficient has remained unchanged. Cluster coefficient is what? Cluster coefficient tells you how much these nodes, how much is the tendency of these different nodes to form a cluster together, or how close can they be, right? So it has also remained unchanged. That shows the interconnectedness has not significantly increased, it has remained somewhat stable only. Is this clear? Right? Okay, so remember, degree of interconnectedness as per connectivity ratio has declined and the cluster coefficient has remained stable, so no more clusters being formed. Is this much clear? Now only few more things regarding interconnectedness and financial sector are remaining, which we will be discussing. Tell me, so far everything is okay? I have tried to highlight the important things, just try to remember those facts, okay? Now, exposure of AMCs and MFs. Now, in this entire thing, if we try to discuss the exposures of AMCs and mutual funds particularly, so the report says that gross receivables of asset management companies and mutual funds, they stood at 16.16 lakh crore. So the figure is unique. You can remember this 16.16, right? This is like the figure of capital expenditure given in the budget, right? 11.11. So this is gross receivable of AMC and MFs. It stood at 16.16 lakh crore. Then if you see for the SCBs and only the private ones, it remained the major recipient of their funding, followed by NBFCs and AIFI. So what you need to remember from here is that to whom have the AMCs and MFs have provided the maximum funds. So gross receivable 16.16 lakh crore, and then SCBs, primarily the private scheduled commercial banks, remained the major recipient of these funds, followed by NBFCs, AIFIs and HFCs. This is the thing, okay? So many reports, but then try to divide the content. How you divide it? Say, if you are watching the videos or reading the report for phase 1, focus on the facts, right? You have understood all the concepts. Now, when phase 2 arrives, then focus on the concepts as well. So, try to divide what you need to look on, okay? And then also try to see the trend, and then we provide you MCQs. We will have MCQs classes on the FSR as well today only, okay? So, based on the MCQs, try to assess which data is important, and then remember that. You have to take risk. You have to take risk. You cannot remember everything, that is true. We have human capacity, limitations of human capacity, okay? That's why I said where there is a risk, there is a way, okay? So, more than will, risk is important. Now, exposure of insurance companies. Let's talk about the exposure of insurance companies. So, insurance companies, gross receivables of the insurance company, yani what do they owe to the other entities? What do they owe to other entities? For AMCs, it was 16.16, remember. Now, for insurance company, it is 9.55 lakh crores, okay? And gross payable is very less. And they were the second largest net providers of funds to financial system. So, insurance companies, they are really performing well. They are providing funds to the other institutions. Then, if you see again, private SCBs, they were largest recipients of these funds from them. So, remember in both the cases, asset management companies, AMCs and the MFs, the largest recipient of these funds is the private scheduled commercial bank, again followed by NBFCs and HFCs. So, easy to remember, again followed by NBFCs and HFCs. Then an exposure to NBFCs. So, NBFCs were the largest net borrowers of funds from the financial system. So, in the entire financial system, who has been the largest net borrower? Largest net borrowers have been the NBFCs, okay? NBFCs. A breakup of their gross payables reveals bulk of funds were sourced from SCBs, and from which kind of institute they have sourced the funds? SCBs. Now, that's why regulating NBFCs and regulating their NPAs and decline in their NPAs is important, because if they have taken loans from the SCBs, maximum from the SCBs, any chances of default on the loans. Now, this is the chain. If you try to define all these points and trends in one line. So, you see retail loan of NBFCs, they were not performing well. That's why more stricter regulatory guidelines, cut down on retail loans, because you as an NBFC have borrowed from SCB. Now, you have borrowed from SCB. If they fail, you fail. Their balance sheet failure translates into your and then translates into the SCBs. So, creates a systemic risk. This is the conclusion of the entire thing. Now, but this is not the conclusion of the class. The class is still going on, okay? So, let's discuss further. The choice of instruments and funding mix of NBFCs have been long-term ones. So, remember, for NBFCs, they have taken more stable and secured form of loan from the scheduled commercial banks, and the choice has been towards more longer term funds. Now, exposure of HFCs, if we see, exposure of HFCs, housing finance companies, what have been their exposure? So, they also remain one of the largest net borrowers. So, tell me quickly, who is the largest net borrower? NBFCs. And the second largest is HFCs. Okay, second largest is HFC. Their gross payable is 5.41 lakh crores, and over 75% of their resource mobilized is through long-term loans or long-term debt instruments. So, both the sectors relying more on long-term debt instruments. Remember the rank. Largest net borrower, NBFC in the financial system, and then second largest net borrower is housing finance company, okay? And via long-term instruments, not the short-term. Then exposure of AIFIs, if you see, All India Financial Institutions, so the gross payable and receivable respectively, payable is 8.04 lakh crores and the receivable is 7.67 lakh crore respectively, right? So they have been net receiver of funds from the financial system. They have been net receiver of funds. Okay. Then they raised funds mainly from SCBs, AMC and insurance companies. Now given their nature of operation, again long-term debt, long-term loan and long-term deposits. So if you see all these institutions, one similarity is there, that they have preferred long-term instruments over short-term instruments for borrowing, so it is easier to remember. You can eliminate the options, right? So this was the sectoral voice analysis of exposures, risks. Now there is this contagion analysis given here. So contagion analysis tells you how much chances, so you have like contagious diseases, right, which is spread quickly. So it uses network technology to estimate systemic importance of different financial institutions. How much systemic importance do you have? If you pose any risk and you are systemically more important, that means any default or fault or crisis or risk from your side could actually spread to the entire system. This is what this analysis tells to you, right? Now under this analysis we have to discuss this thing, joint solvency or liquidity contagion impact on SCBs due to bank failure. Now there are these conditions. If this happens, what will be the impact, right? So say any reason due to which bank failure happens, right? So what will be the liquidity contagion impact? What will be the impact on the liquidity on your scheduled commercial banks due to any bank failure? So the report says that if a bank with maximum capacity, if the bank with maximum capacity to cause contagion loss fails, a bank with maximum capacity to cause such a loss, it fails, it causes a solvency loss of 5.06%. Joint solvency we are talking about. All the SCBs, for example, not a particular one. So it causes a solvency loss of 5.06%, okay? And of total tier 1 capital of the SCBs, and a liquidity loss of 0.31% of total HQLA of the banking system. Remember this figure. So tell me, this is not a big cause of worry. That means even if the most important bank in the system fails, your systemic risk is lesser prone, your system is less prone to any contagious impact. This is what we conclude, right? Even if it fails, so the solvency loss would be not only, but it is not that much significant to cause significant harms, right? 5.06% of total tier 1 capital of the SCBs, and liquidity loss will be only 0.31% of total HQLA, right? So this is not a bigger issue for us. Also, it is not going to lead to failure of any additional bank in that case. Remember this thing. No other bank would fail. Now it tells you how much strength does your financial system holds, right? So that was the impact if one of such bank fails. Now the other analysis tells you if any of the NBFC fails, if any of the NBFC fails. Solvency contagion impact on scheduled commercial banks. So impact on the SCBs if any NBFC or any HFC fails, right? So by end of March say 2024, a hypothetical failure of, so this just hypothetical, if we imagine that an NBFC fails with the maximum capacity, an NBFC which has maximum capacity to cause losses to the banking sector fails, it can knock to 2.29%. 2.29% of the bank's total tier 1 capital but it would not lead to failure of any bank. So if any of the largest NBFC even fails, that would not lead to any bank failure in terms of scheduled commercial bank. This tells you how much strength your system has. So if you reach to the interview, right, I hope you all reached to the interview, and then they ask you these kind of questions. So this is the preparation. I know we have taken time to cover the reports, but then for examination, you see, just go through the facts before phase 1, then go through the concepts in phase 2, and then now you know the analysis of what is going around to appear in the interview, right? So at least you can answer. If they ask you what is the strength of the financial system, you have these analysis because you have tried to understand what is going on, right? Similarly, hypothetical failure of the HFC, if there is any, would knock off say 3.87% of the tier 1 capital, again without failure of any bank. So no bank is going to fail in this case. No bank is going to fail in this case. Now, solvency contagion impact after macroeconomic shocks. Now, if there is any macroeconomic shock which happens, shock due to any adverse change in the macroeconomic indicators or parameters, what can be the impact on the SCBs? So, it can be there, right? So, the initial capital loss due to macroeconomic shock stood at say 3.10%, 12.55% and 21.29% of tier 1 capital for baseline, medium and severe stress. So, according to the stress, baseline scenario tells it will be 3.1, then medium scenario tells 12.55 and severe stress tells 21.29, and then no bank fails to maintain tier 1 capital adequacy of 7% in the baseline, medium and severe stress scenario. So this entire thing tells you, even in the case of macroeconomic shock, your tier 1 capital can be wiped out by this much percentage in these three different scenarios, but still even in the medium and severe stress scenario, you would not fail to maintain the minimum tier 1 capital requirement out of the total CRAR which is there for the SCBs, and which is 7%. So minimum tier 1 7%, you will not be able to or you will be able to maintain that. You will not breach or fall short of this target, right? So there is, what do we conclude from here? There is no additional solvency losses to the banking system due to any contagion impact. Okay. Now, RBI's enforcement. So regarding these risks, and after these macro tests, whatever findings have been there, what has RBI done so far? So just remember 2-3 figures from here. During December 23 to May 24, RBI undertook enforcement action against, after all these stress analysis, against 161 regulated entities. Remember this thing, important. So such action has been taken by RBI on 161 regulated entities. Now the constitution is also important. Among this 161 regulated entities, 4 are PSBs, 9 PVBs, 1 SFB, 1 foreign bank, 2 regional rural banks and 132 cooperative banks, 9 NBFCs and 3 HFCs. So which is the highest number? Who has been the highest in the highest category or largest regulated entity which is there against which the action has been taken? It is the cooperative banks, right? So 132 cooperative banks, against them the action has been taken, remember. So this figure becomes important, 132. Okay, remember the total entities against which this action has been taken in different forms like penalties imposed and all is 161. Now penalty imposition, so an aggregate penalty, if you see in aggregate penalty in crores, so it is 22.83 crore. So they have earned from this penalty, right? So this is again the source of income for the RBI, but then again it is a penalty imposition. So the aggregate penalty imposed on all these against all these action is how much? 22.83 crores for non-compliance or contravention of statutory provisions or directions issued by RBI. For any directions, provisions, compliance, guidelines, statutory provisions given by RBI, if you have not complied with or if you have breached those guidelines or those norms, then in that case the total penalty levied for such cases or such non-compliances at the aggregate level, it is 22.83 crore. This figure is important. This figure is important, remember. So total of 161 regulated entities have been there against which action has been taken, and total of 22.83 crores of penalty has been imposed for non-compliance of RBI's statutory provisions or guidelines or whatever. Now this is the end of the report. We have discussed everything which is important from the report, right? So we have completed, now I can say we have completed the financial stability report in very comprehensive manner. Now for you, I would suggest, if you want to revise the lectures for phase 1, go through the figures and trends, then come to concepts again for phase 2 and then interview, right? Both the things for interview. So this is the thing. I hope this becomes useful for you. See, if you understand the concept, it becomes easier to remember the fact as well. That's why I have tried my level best to explain each and every concept. This was very technical. I hope it becomes useful for you. Please keep on revising the figures and the concepts so that your time does not gets wasted. याद कैसे रखना? You have to do multiple revisions. No one can help you. Like, so this is not something like a powder which can be dissolved in water and you drink the water. There is no shortcut. You try to create your own ways to remember the figures. You can make mnemonics, as I have given hint in the budget MCQs, budget discussion and all, and give multiple revisions to them. That's how you can only remember the figures, right? And try to find out which are important. Do not try to remember each and everything which is there. I hope this is all these classes of the report are helpful for you. It will help you in the entire course of examination. And thank you so much for staying tuned for so long. And I hope you all get benefit out of it. All the best to all of you. And keep on revising these reports as well. We will have MCQs of FSR today only, right? We will have a class on the MCQs as well. So you can practice those MCQs. Whatever figures have been asked in the MCQs are very, very important. And then it gives you a hint, okay, this is the trend or this is something which you need to focus upon from the entire PDF, okay? So thank you so much. I'll see you in the MCQs class. We have completed the FSR report. Thank you so much for staying for so long and staying tuned. Good luck. Have a good day. And I'll see you in the next class. Thank you so much.